Bill, I want to go over the job market and then get right to the turmoil, the idea that we see higher rates and lower bill note and bond yields as well. This looks like a Yellen-friendly jobs report. It looks like a jobs report that lets a Fed, gives them some room to raise interest rates. What will be the effect when the Fed raises interest rates?
Well, they've been raising interest rates, and the effect depends, I suppose, Tom, on how much they raise and when they raise. I still think, despite this rather strong jobs report from the standpoint of jobs gained, not necessarily from wages, which is what Yellen watches seriously as well, that the Fed has one hike perhaps left in the year, and that's probably in December. I think to a significant extent it depends, as I've mentioned in prior discussions with you, it depends significantly on what other central banks do, and if the ECB and the BOJ and others tend to change their policies, then the Fed must not respond, but as a leader, as the central bank global leader, they've got to be cognizant of what it might do to currency levels. And so they're all in the pot at the same time. And I think your question about the Fed is important, but it's also important about other central banks around the world.
With what we've observed in the last number of weeks, and of course we've got rising rates, and we'll get to bonds and investment here in a moment, Mr. Gross, is the idea of a Fed that is coordinated and yet at the same time constrained. How coordinated are the central banks, and how constrained is Chair Yellen because she's limited by other global activities?
Yeah, I don't think they're coordinated at all yet. Obviously in the last few weeks there have been hints from the ECB and hints from the Bank of England that they're on the move, or potentially on the move at some point 6, 12, 18 months down the road. But they're still, a long way back from when we stopped QE, and a long way back from when we started to raise our short-term interest rates. And so they're beginning to be coordinated from the standpoint of philosophy, perhaps, and the direction, but certainly not in terms of timing and magnitude. And I think ultimately that does have a significant impact, or will, on currency levels, and central banks want to keep those currency levels relatively static. Admittedly, each wants to, to lower their currency a little bit so that it gives a push to their real economy. But they've got to keep things steady, and so the future coordination I think is important. It hasn't been coordinated to this point.